Thank you for joining us and for setting time aside this morning to share your expertise on this important subject. To our esteemed customers, my colleagues in NCBA, ladies and gentlemen, my name is Tyrus Moidiga. I'm the Group Director responsible for retail banking business in NCBA Bank, which is the business that is responsible for services to our retail customers, SMEs, and all our operations in the branch network. Thank you for logging in this morning. It's a pleasure to have you. And as I said, the topic today, navigating the tax landscape, must be one of probably the most important topics any small, medium, even large business has to deal with. We very often, when we interact with our customers in forums, and the beginnings of this session actually began at the SME session last year with Strathmore University, where tax and compliance to tax and understanding liabilities to tax was actually one of the biggest areas of support and help that a lot of our customers said they needed. Benjamin Franklin once said, the Constitution is established, it has an appearance of permanency, certainly except death and taxes. So it's something that I think in life, in nature, we really cannot avoid. It's part of being, as long as you generate any income of any sort. I think tax is one of those existential things for businessmen, and probably the biggest fear sometimes when KRA is probably more feared than the bankers, unfortunately. That said, understanding this subject I think is important, and especially when we take a step back and think about the year that we've just spent. As you're aware, the COVID coronavirus disease pandemic has had a significant impact in the Kenyan economy and on businesses. The government has recently cautioned us that we're in the middle of what appears to be the third wave. Infection rates are hitting highs that we've never seen before. We unfortunately set a record earlier this week of the highest number of infections ever reported since more than a year ago. There's been more than 121,000 confirmed cases, over 2,000 deaths. And while many have recovered, it is a reality for many business people that we've had to rethink very fundamentally our business models, both from a banking perspective, even large corporates and SMEs. Anyone who had a plan that worked, I would admire those. Most of us realized that a lot of the business resumption plans, a lot of the strategies that we had became significantly disrupted by this unprecedented event. We are optimistic, however. We are cautiously optimistic, however, when we look forward to this year. Our economic outlook for the year is projecting a growth of around 4.2, maybe an average of 4% this year. We are already seeing a resumption in the economic activity of almost near 80% of the levels that pre-existed before the disruption of the pandemic. The World Bank Group is a little bit more optimistic. I believe their projections are nearly as high as 6%, 5.9%. What all this speaks to is the resilience that we enjoy in the Kenyan economy, the resilience particularly of SMEs. And so in this context, when you think about the resumption of business, a very impacted situation, we obviously have to now really turn our focus to what's my tax obligations, what is the support I need to understand, particularly to give Caesar what famously belongs to Caesar. Now, more so the recent tax changes, I think there were, in part because of the support that the government offered to SMEs and corporates through the pandemic, and even to individuals with various tax relief, some of those that have expired. The changes in the tax framework and the tax code in Kenya This morning, as I was looking through the paper, I saw a large notice on tax on digital financial services. So this webinar, I believe, ladies and gentlemen, comes at an opportune time to enable a lot of us that are listening and those that will be viewing the recordings later to understand how tax affects your bottom line, what are your obligations existing or that have shifted, and to try and demystify what is sometimes a very complex project, complex subject, but also with the right support and advice, perhaps not as complicated as some of you or some of us have thought. In the past, NCBA Bank has organized a lot of forums and opportunities for SMEs customers to improve their business, whether those were trips to China, collaborations with Strathmore University through the SME Forum, which we have been running over the last 9 years, and even trainings that are specifically arranged for SME owners and operators to undertake a course of study that improves their management and oversight over their businesses. We've also run a number of webinars. And so this is part of that ongoing effort to partner with you as a thought leader, as a partner beyond banking, with the intention that if you're a better businessman, if you're running a better business, then you're a better customer. And by extension, I become a better bank. At NCBA, we value you, and the numbers that matter to you matter to us. And so tax is probably one of those numbers that should really matter to you and your accountants. And so I do hope that you will find today's deliberations insightful, educational. Do take the opportunity to post any questions that you have on the Q&A tab. We will share contacts of Stephen Gakuya, our Director for Business Banking, and his team, for Christine as well, so that we can engage and see how we can better partner to support you in the numbers that matter to you, and also the numbers that matter to KRA, I have to say. Ladies and gentlemen, without further ado, let me introduce our keynote speaker, Christine Kahemma Mudhui, who's the founder and director of Alpha Tax, and has over 18 years experience in the tax space and in matters regarding to tax. Before founding Alpha, Christine worked as the tax manager at Coca-Cola for the East, Central, and West African markets for 9 years. And before that, worked for KPMG for another 8 years, supporting various clients from a tax structuring, optimization, compliance, and advising on mergers and acquisitions. She holds a degree in Bachelor's of Law from the University of Nairobi, is an advocate of the High Court of Kenya, also a certified public accountant, and also a certified public secretary. She has an MBA for executives from the Strathmore Business School. Christine lectures on a part-time basis at the Strathmore University and is pursuing a PhD in commercial law, taxation at the University of Cape Town. I'm not sure what she's going to read after this, because I think she will have covered everything that there is to read on tax matters. She's a member. The only job left for you, Christine, will be perhaps at the tax authority, which will be maybe a little scary. She's a member of the Public and Tax Committee at the Institute of Certified Public Accountants, ISPAC, and the Tax Committee of the Law Society of Kenya. We've worked closely with Christine, and she has worked closely with stakeholders to review tax legislations and the shaping of future tax laws. I think with that background, you can see that she really is the right person to be having this conversation with. And so we thank you for your time. We look forward to an engaging conversation this morning. So without much ado, Christine, welcome. The floor is yours. And thank you again for your attention.
Thank you very much, Tyrus. I'm glad to be here this morning. Thank you to Steve as well and the entire NCBA team. Thank you to all the clients who've actually dialed in for this session. I'm very passionate about tax, and our focus today will be on taxation. So I'll share my screen. Our subject today will be navigating the tax landscape. And you might be feeling the pressure as a taxpayer. KRA is on my back every single day. And I can tell you, it's not, they're also feeling the pressure as well. I can tell you the IMF and other Bretton Woods institutions have been pressurizing government in respect to the corona tax cuts that we got. And that's why we've seen the reversal of the same so quick, while we were hoping that taxpayers will get a little more time in order to settle business before that changes. We're also seeing a lot of tax cases currently at the tax tribunal. And what was reported on 23rd of February is that 133 billion is actually installed cases. Why is this the case? We are seeing a very litigious taxpayer. At the same time, we are seeing a very aggressive revenue authority. The CS Yatani has actually informed us we need to brace ourselves for tough times. And so as to set the scene, let me just give you context where the pressure is coming from. Let's use the last financial year, 2020-2021. Government's projected expenditure, actually without the county allocation, was about 2.7 trillion. Whereas KRA was targeting to receive 1.6 trillion. So there's already a deficit. And the 1.6 trillion, you can actually see with COVID, with the locust issue, with the floods issue, was also extremely difficult. So it's either debt or taxes. That's the only way that government is able to get funding. I know this is one area where we pushed, even last week when we were engaging government through the National Treasury, and we're asking them, why do you want to just look at it as debt and taxes? What about we really check on our expenditure? And the Director of Fiscal Policy told us they've gone through the expenditure with a tooth comb and there's no more that they can reduce. So it's either the taxes or debt. Now, when you look at debt, we're almost hitting 8 trillion from a debt perspective. And I can show you here that even when you look at the 2020-2021 debt obligation, it's actually at 904 billion. So that's all we need to pay as a principal amount and interest. Now, we are collecting 1.6 trillion. About half of that is actually going to pay debt. So we are left with such little amounts to service the recurrent expenditure and the capital expenditure. So there is a lot of pressure, mainly from the IMF, because the tax to GDP ratio is really low for Kenya. It sits at about 17.4, while the OECD, which incorporates many of the developed countries, is at 34.3%. So this is the amount of tax that government is able to get from the economy. So the challenge is, for you to be able to collect effectively, you must increase the tax base. Now, in most of the African countries, because of the way the system is, it becomes very difficult to increase the tax base. So what's happening is that the 20% that have been compliant are receiving the hit with the introduction of new taxes, with the focus from a government perspective to collect more. If government is really able to increase its tax base, we'll be able to spread the tax obligation across many taxpayers, and that will create some relief on the current taxpayers who are paying taxes. So currently, government works on a Pareto principle. Let's collect from 20% who give us the 80% at the lowest cost. If they're able to increase that tax base, it will be very, taxpayers will feel less of the pressure. But I can tell you, that's why you're experiencing the pressure. Looking at the performance, this was actually from the KRA website, you will see that there's been a decline in most of the taxes when we review 2020-2021. Most taxes went up except VAT. It went down because of the reduction in VAT from 16% to 14% last year. Domestic excise tax actually went down. Excise tax is mainly on alcoholic drinks, soft drinks, luxury deemed items. It seems taxpayers actually cut down on that. Fuel taxes also went down last year. There was less of travel. PAYE grew slightly. Capital gains grew as well. Rental income grew because of KRA's, the introduction of the new app. So we are seeing that some of the taxes actually, if you review July to November, actually that's 2020, that went down. Then December to January 2021, there's been a slight improvement. And this improvement was attributed to the resurgence of the economy, as Tyrus has actually mentioned. There was a bit of relaxation of the stringent COVID-19 containment measures. There was a post-COVID recovery plan where government was able to incentivize some of the sectors of the economy. There was some increased enhanced compliance, and there was the reversal of COVID tax incentives. Last year, because of the tax incentive, government actually lost 170 billion. That's why for sustainability, those had to be reversed immediately in 2021. We tried to push because we were seeing the effects of COVID are being felt this year. Most taxpayers last year did not even enjoy the cut, the decreased PAYE, the increased PAYE brackets because they were not even drawing a salary then. That didn't happen. Most of these incentives were reversed. So what's KRA's focus in 2021? We will talk about the introduction of the digital service tax that came into effect from 2nd January 2021. The introduction of minimum tax. This is one area that has caused a lot of issues, and there's been constant engagement with government in respect to the introduction of minimum tax. I will explain that shortly. Then there's a voluntary disclosure program. You've heard about the tax amnesty, so we will look at that. There's been increased comprehensive audits, and I can tell you, please expect an audit this year. And the way to work on that is ensure you take the voluntary disclosure program. There's also a lot of profiling and targeting. We are seeing a lot of tax economic crimes related issues. So that's how KRA is focusing this year. You will continue to feel the pressure at the taxpayer. And you might have already started feeling a letter from KRA telling you you've been appointed as a rent withholding agent. And you're wondering, who's supposed to do all this compliance? I'm not being paid for assisting government to collect taxes. I just receive a letter. On what basis did they decide it was me who was to receive that letter? Same thing with withholding VAT. You get a letter that tells you you're now been appointed by a withholding VAT agent. Remember, government is trying to collect the most amount of tax at the least cost possible. But that doesn't mean that you shouldn't push back and say, I do not have resources or I do not have systems to start complying with this obligation. Most taxpayers actually receive this letter and they start complying immediately. Try and push back. You might actually get a feedback from them that saying your explanations are duly noted and we have withdrawn the appointment. So in these days as a taxpayer, you really need to be more alert. Don't sit on those letters. Try and see what best you can do. Consult a tax advisor to provide you with some context in that regard. So I can assure you, if you're a taxpayer and you're feeling the pressure, it is something that is across board that all taxpayers are certainly feeling. One interesting one is one that one of my clients got on rent, and he was told you've got 23 rental houses within Kiambu. Your estimated rent is 9,000, but you haven't been paying any tax. And it's interesting because this client didn't have all those units, but when he drew his drawings, took them to the ministry for approval, there were 20 houses. They are not complete. But now what has happened? The burden of proof has been shifted from KRA to yourself. It is you to come now and say, actually, I have some houses, but they are not 23. The rent is 5,000, and this is a tax. Forgive me, I haven't been paid. So that's how they're using. That's what they're using. There's a lot of interconnection from KPLC where you applied for the meters. So as a result of this, I want to assure business, it is not business as usual. Tax management has to be at the core of your business. There's a lot of pressure, push and pull from the taxpayer and by government. And why is this the case? From a government perspective, we are seeing a more sophisticated response by governments. They have the iTax platform, they've got the tools that they use. They're receiving, the revenue authority officers are receiving training from the US, from the UK, funded by the Bretton Woods institutions, which are targeted at increasing the tax base. As I said, our tax to GDP ratio is pretty low. Yeah. Then there's a lot of tightening of perceived loopholes. These are tax loopholes. I mean, for us tax practitioners, we are very good at tax planning. And remember, tax planning is using the legal routes in order to decrease your tax liability. But also those tax planning opportunities are being tightened every single day by government and the revenue authority. We are seeing a lot of scrutiny by revenue authority officers. It's not business as usual. You get a question by a revenue officer, I mean, this input, how come the output was this? You know, you're told you need to justify your waste, and you're wondering, have you now become engineers? Am I supposed to be telling you this, or should I be telling the quality control manager? You know, then there's a lot of focus on cross-border transactions. And as I say, there's reliance on IT systems. On the other hand, the taxpayer is experiencing increasingly complex tax legislation. Every single morning for us, we are receiving, oh my goodness, there is a new law. There is a new bill introducing a new law. What do we need to do? Last year, just as a case in point, we had the Tax Laws Amendment Act in April. We had the Finance Act in June. Then we had the Tax Laws Amendment Act number 2 in December. All those came with different tax requirements. So the taxpayer is really experiencing an increase in complex tax legislations. Secondly, the penalties for non-compliance. You look at your iTax platform and you're saying, oh my goodness, all these penalties have accrued. Or you receive a demand from KRA and are wondering, where is this from? Where did it come from? Taxpayers are also experiencing cash flow issues. And you know cash is king. There is no amount to pay. You have billed a client. You have charged VAT. The tax point for VAT is raising the invoice. The client is having challenges paying you, but the VAT is due. I mean, it's such difficult times for taxpayers. We are seeing a lot of decreased profitability by companies, increased restructures, and closure of companies. As I say, from a government perspective, they are trying to increase the tax base. However, that can be really strenuous on compliant taxpayers if the tax base is being increased on those who already comply. So you as a taxpayer needs to be very proactive from a tax management perspective. We will look at different ways of proactivity because it's critical for your survival as a business. A lot of businesses have actually closed because of tax. Sometimes you receive a demand and you're wondering, my goodness, this demand from KRA is even higher than my profitability or my turnover. How am I supposed to pay? I'm better off closing. And you know, closing companies is very difficult. Sometimes government may decide to even lift the veil of incorporation and follow you as a director in order to collect the tax. So we will look at different ways in which you can proactively tax manage because it's critical for sustainability of your business. I always say tax compliance is the first way to tax plan. You know, most taxpayers say, I have a tax compliance certificate and therefore I'm clear from a tax perspective. That's not the case. Remember, the tax compliance certificate is just telling KRA, based on what you've put on your iTax platform, we are clean. We are on a self-assessment basis. So it is expected that you will be the driver of your taxes. Okay.
Christine.
Yes.
I'm sorry, the microphone seems to be muting. I don't know if you could just check that, please. I'm sorry to interrupt.
Okay. Is that better now?
Not much change.
Tyras, am I clear now?
Yes, much better now.
Much better. Okay.
Thank you.
Thank you for letting me know. Just alert me in case of anything else. Okay. So from a tax compliance perspective, as I mentioned, some of us feel that as long as you have a tax compliance certificate, you're clean. That's not the case. As I said, we are on a tax assessment system whereby I say what tax I have to pay. So the tax compliance certificate is telling you that based on what you've put on iTax, you're good. Yeah, but that does not necessarily mean that you're 100% tax compliant. So What you need to know from a tax compliance perspective, please ensure you comply from your normal tax, for your normal taxes. VAT is due by the 20th, withholding VAT is due by the 20th, PAYE is due by the 9th, and withholding tax is due by the 20th. Then you've got your installment taxes. Just ensure you have a calendar that marks that to ensure that you are compliant and you do not fail from a tax perspective. Why is this the case? The penalties for non-compliance are very high. They range at about 10 to 20%, and then there's a 1% interest. I mean, it's easier to even get a loan to pay this interest as opposed to the interest accruing on you. So what if I do not have money to pay? Because that's one of the questions we get from the taxpayers. What do you need to do? You can actually apply for a payment plan with government. What if I forgot to declare the tax? You need to ensure that you declared and paid because it doesn't disappear. And let me tell you, you might be wondering, how will I be caught? I mean, tax can be punitive, taxpayers. I totally understand that. But now the system is so interconnected. I'll give you some examples. So for example, from a corporate tax perspective, you haven't declared your corporate tax, but someone withheld tax from you. As soon as that person withheld tax, there is a trigger on KRA system that says 5% has been withheld. I'm expecting the rest 25% when you're filing your self-assessment return. So that's how withholding tax exposes you. From a VAT perspective, you might be saying, I have raised this invoice. I have VAT, output VAT. I haven't paid. Remember that invoice, someone else is claiming it as input VAT. So it triggers government and they say, I am expecting output VAT. If I don't receive it, I need to know why that's the case. Okay? Rental tax. Tenants, I mentioned, tenants of drawings submitted by the ministry, that's also exposing you from a tax perspective. VAT, withholding VAT exposes you. You've rendered a service to a withholding VAT agent, then we've withheld VAT. What happens? It's a trigger. There's a withholding certificate that has been generated, therefore VAT is due. That's from a compliance perspective. Let's look at it from a tax planning perspective. Tyrus, is the volume still good?
Yes, perfect. Thank you.
Excellent. Tax planning. As a taxpayer, you really need to take advantage of every single opportunity for tax planning. But what is tax planning? It is paying the right amount at the right time and in the right way. We are not saying you're evading taxes. You're actually planning. So it is a process of putting in tax strategies that will help you exclude, defer, or reduce the amount of tax that will have to be paid within the legal framework. Remember, I'm a lawyer. It has to be within the legal framework. So let's look at some examples. As I earlier mentioned, the tax point for VAT is the earlier of the date of the invoice, the date the goods were supplied, the date a certificate was issued, and the date the payment was received. Okay, so most of us, the tax point is usually at the date of the invoice. But what happens? You get a job, you want to raise the invoice at any point in time. Please, let's be very conscious as to when we raise the invoice because the tax point for VAT crystallizes at that point in time. The best way would be to raise the invoice on the first day of the month. Why is this the case? Remember, the VAT is due on the 20th of the subsequent month. So what happens in that case? If I raise it on the first day of this month, I have 30 days for the month of March, and I have 20 days in the month of April. That gives me 50 days to either have been paid by the customer or have gotten money maybe from somewhere else to pay the VAT. Remember, if I raise the invoice for example, on the 29th of March, I only have 21 days to pay the VAT. Therefore, I'm really not managing my cash flow well. So as much as possible, let it just be a trigger. It might feel something small, but I can tell you it is so, it has a great impact, because you will have to declare that VAT in the VAT return. If you fail, liability now crystallizes. So think through it. Another way to manage that is to ensure that you negotiate for better terms with your suppliers. You tell them, remember, I have to pay this VAT. Are you able to pay me even if it is 50%, so that I'll have cash flows in order to pay my VAT? The penalty for late payment of VAT is 1% interest every single month. So this is something you should consider from a tax planning perspective. VAT refunds. We've seen taxpayers who make zero-rated supplies. They've paid taxes in error. They've got VAT relating to bad debts, but they've never submitted for refunds. Consider that. Cash is king. Put in your application early. As I mentioned, KRA is now operating on a FIFO method. Fast in, fast out. When did you submit your refund claim? So in order to benefit from that, put your VAT refund claims timely. Make sure you put in a submission of VAT on bad debts, and these are debts that you had paid VAT for, but you have not been paid by a supplier. Put in your application to get a refund for that. So that's from a VAT perspective. Now, the big one, corporate tax. This is a simple tax computation. We always start as tax practitioners from the net profit as per account. And then we add back expenses that are not allowed for tax purposes. And then we deduct capital allowances, other deductible expenses. That is how we determine the adjusted taxable profit for tax purposes. The tax is not 30% of your profit. We need to adjust it for tax purposes. So what in essence you're trying to do is, from a tax planning perspective, reduce the add backs. That's the disallowed expenses, your general provisions, your restricted interest, and increase your deductions. That's your capital allowances and other deductible expenses. So maybe just to give an example, with the general provisions, those are added back for tax purposes, but it is possible to actually make them specific. See that your debtors, review them, have documentation to show that you've tried to follow up on that debt. What does that do? It changes your general provision into a specific provision, and that will be allowable for tax purposes. Most of us have been working from home, and remember, under Section 15, you are allowed to take a deduction of expenses, but most SMEs sadly fail to track those expenses. So you are working from home. Have you considered apportioning your rent that you're paying at home, and say, my office now is in the SQ, or my office is in this room. This is my rental contract or my lease contract. I will apportion and show that this is a rent amount for purposes of the space I'm occupying. Same case with security costs, Wi-Fi cost, Zoom subscriptions, lunch, travel costs, online advertisements, the cost of medical insurance. Please keep track of these expenses. Have documents supporting it. Remember, the burden of proof is on you as a taxpayer. If you are to allow this as an allowable expense, you must show that you have tracked them and you've got receipts supporting this. So you need to be more proactive as a taxpayer. Have you claimed your capital allowances? I look at a lot of books for tax for SMEs. They never claim wear and tear on their laptops. They do not take advantage of assets that they have bought to generate income for their businesses. Something to consider, track them. Capital allowances, though they've been reduced or rationalized effective 2020, they still help in reducing your taxable income. Other corporate tax issues, ways of planning from a corporate tax perspective. You know, for purposes of installment taxes, you can go current year or installment tax. I'll talk about minimum tax shortly, because that's a new one that will have an impact on the installment taxes. So consider, if you were doing prior year and last year you made a loss, you better go prior year this year, because If you go prior year, this year, you won't need to pay taxes. In the current year, you will pay it entirely as a balance of tax. So that's something to consider. But that is, you have to work that out with respect to minimum tax as well. So we will talk about that shortly. Utilizing withholding tax credits. I have an installment tax to pay, and I have withholding tax credits. Offset those. All of those credits are on your iTax platform. I know at the moment, KRA has been very difficult in allowing taxpayers to claim, to use the overpayments that they've had to offset against future taxes. So what do? Avoid instances of overpayment, because once it's paid to Caesar, getting it back becomes very, very difficult. Okay, from a pay-ye perspective, we've seen instances whereby you decide as a taxpayer, let me employ a consultant instead of an employee. When you do that, please ensure that that consultant meets the criteria of a consultant. Because if you're audited and he's deemed to be an employee, the tax obligation will significantly increase, and you as an employer will be required to pay the pay-ye. So a consultant must be independent. He must have his own tools of trade. He must have some specific know-how that he's bringing to the business, and he is not supposed to be entitled to any benefits. Now, if it's an employee, you will have control over that employee. So you as an employer cannot have control over a consultant. If the consultant receives leave days, he ceases to be a consultant, he becomes an employee. So this is one area that we've seen for most SMEs because of the way cash is king. There's a cash flow issue. You really don't want to employ employees. You want to work with consultants. Just be careful how you engage them. Ensure that you have a contract so that that consultant is not deemed to be an employee. We've seen assessments on SMEs. You're told you have all these employees, you haven't paid their tax, and it becomes a very difficult position because there was no documentation. From a tax perspective, you as an employer, you pay some amounts to your employees. Remember, for tax purposes, almost everything paid to that employee is subjected to tax. So what you're trying to do is manage that in order to reduce your tax liability. Or you as the owner of the business is also paying yourself some money. So from a per diem perspective, remember, if you're giving per diems to your employees, the first 2,000 is deemed a reimbursement and is not subjected to tax. The balance, if it is supported with invoices and receipts, that will also not be subjected to tax. Now, sadly, what we see is that businesses give their employees, or even the director or the director of the company gets a per diem, but there is no support. So KRA comes and says, okay, you're saying this was not taxed, please provide me with support. You don't have it. So it's a lost opportunity for tax planning. School fees, if you pay employees school fees for their dependents, and or the director's school fees, and he's a full-time or a whole-time service director, that will not be taxed on the employee. It will be taxed on the employer. So how is it taxed on the employer? It's disallowed for tax purposes. But this will only not be taxed on the employee if the employer is a tax-paying person. So the company is paying taxes. So for an NGO, if they give the dependent school fee support, that will be taxed on the employees because the NGO is not a tax-paying entity. But for example, for Alpha, if Christine receives a dependent school fees, and this is school fees paid directly to the school, it will not be taxed on me as Christine, but it will be taxed on Alpha. So it's a benefit from a timing perspective because Alpha will pay its tax quarterly, whereas Christine she's paying her tax every month. So it's a cash flow timing, if it's from a cash flow timing perspective. And it's also even beneficial if the company is making losses because even if I add back, the tax liability does not crystallize immediately. Non-cash benefits, remember, if you give an employee a non-cash benefit, the first 3,000 every month is not subjected to tax. If it crosses 3,000, that's 3,200, you have to subject it to tax. So be conscious about some of these little things as you structure your business affairs. We've got some non-cash benefits. So Christine works for Alpha. Alpha decides to pay for Christine a pension, be it 10,000 or 20,000. The 10,000 is not subject to tax on Christine as a benefit. So Alpha pays to ICA, for example, a pension. So it's usually to a maximum of 20,000, but you consider the employee contribution as well. So if Christine is contributing 10,000, Alpha is contributing 10,000, the 20,000 will be allowed for tax purposes on Christine and on the employer as well. So that's an uncash benefit. So instead of giving Christine a bonus or an additional bonus of 10,000, tell Christine, I will contribute an amount of pension to a pension scheme so that we can reduce the tax burden in that respect. It will not be taxed on you. So any amounts over and above the 20,000 become a taxable benefit. We've got some exempt income. Agree with your associates. I may not be in a position to add your salary now. Let's consider getting you a medical cover. In that case, that's an income that is not subject to tax. So Christine is enjoying a medical benefit as opposed to Christine getting a 10,000 bonus to help her assist her in taking up maybe a medical cover on her own. So that may be a way in which businesses in this time may decide to go so that you reduce your tax burden. The medical cost will be an allowable deduction on the company. The medical benefit will not be a taxable benefit on the individual. Same with group life insurance. Allowable deductions, this is now on the individual. As Christine, as I said, if I contribute to a pension scheme, for example, if I earn a salary of 100,000, the entire 100,000 would have been subjected to tax. But if as Christine, I contribute to a pension scheme, 10,000, the taxable amount now becomes 90,000. It's legal, it's based on the law. Christine also has a mortgage with NCBA. The mortgage, I pay interest expenses, interest of 300,000 a year. So if I divide by a month, I divide on a monthly basis, that's 25,000 of interest is an allowable deduction. So Christine was earning 100. She deducts 10,000 because she contributes pension. She deducts another 25,000 because she has a mortgage and is paying interest. We call it an interest relief. So of the 100, I'll now deduct 35. So I'll be subjected to tax on 65,000 as opposed to being subjected to tax on the 100,000. I have used the legislation to my advantage to reduce my tax liability. We see people with mortgages, never do they take the interest relief. They contribute to a pension. They have never let the employer know. And with this pension, it doesn't really have to be an employer pension. It can also be an individual pension if, for example, the employer does not have a pension scheme. So these are ways in which you can tax plan as well. Insurance reliefs, you have a life insurance, you have a health insurance policy, you have an educational relief. You are allowed to get a relief from your tax liability. So remember, the deductions were reducing your taxable income. The reliefs are further reducing your tax liability. So let's say my tax is 30,000. I have premiums. 15% of those premiums amount to 5,000. I will reduce the tax liability by another 5,000. So that's a tax opportunity from a tax planning perspective. When we look at it from a withholding tax perspective, this is where you've received a service and you need to account for withholding tax. Sometimes these services may be rendered by non-residents who say, I want my amount gross. I do not want you to deduct. You'll have to take up that cost. So you need to look at Where am I getting this service? Because let me give you a case in point. If I get the service from the US, the current withholding tax rate in the US is 20%. If I get the same service from the UK, the rate is 12.5%. If I get it from India, the rate is 10%. So you need to have this in mind so that you can be able to determine how to reduce your withholding tax obligation, because in some instances, that might be a cost of business on your end. Another issue we've seen as consultants is you've rendered a service as a consultant, but you have not split your invoice well. Maybe your invoice has a fee element and it has disbursement element. The other party withholds on the entire amount. Yes, you can claim it as a credit, but it may affect your cash flows. So you need to be alive to that so that you ensure that the tax is only deducted on the fee element. It is only in training where the law says that incidental costs form part of the base for withholding tax. But for the other services, the withholding tax is on the fees. So split your invoices so that you show the fee element and the disbursement element so that not the entire amount is subjected to withholding tax. So those are the ways of tax planning that you can consider incorporating in your business in order to proactively manage your tax. So we've looked at tax compliance as a proactive way. We've also looked at tax planning. Our focus now will be on managing revenue authority audits. You get a demand or a notice of an intention to audit from KRA. Some taxpayers sit on it. Some taxpayers don't even receive a notice of intention to audit. The revenue authority officers just show up. They're not supposed to just show up. They're supposed to send you a letter because that is a requirement under Section 59 of the Tax Procedures Act. So don't get intimidated as a taxpayer. You also have a right as a taxpayer. So you will need to get a letter. So if they come, tell them, we understand you would like to do an audit. Please send us a letter. Tell us when the audit will commence. Tell us what areas you will focus and let us know the KRA or the audit officers who will be doing this audit. Why is this critical? You need to do that so that you can be able to prepare. You can be able to also just review your affairs and see, are there areas of exposure that I need to be aware of so that it's not a shock when the audit commences. And we always give taxpayers some tips. Before the audit, talk to your tax advisors, invite them for the meeting, appoint one contact person to deal with KRA. Why is this the case? It helps to avoid off-the-cuff questions. You know, KRA officer may ask a question and you have 5 people dealing with them. They may conflict in the feedback that they give. So just have one person say you will be the person who deals with the revenue officer. Try as much as possible and keep your senior most person off until the last stages. This just gives you another opportunity of having a more senior person, giving the broader context of the company. And remember, we always say in life, we don't get what we deserve, we get what we negotiate for. So it gives you an opportunity for further negotiation within the legal needs. Okay, during the audit, be cooperative. Don't throw those revenue officers in a room that is dusty. I mean, they're also human. So as I said, avoid off-the-cuff questions. Critical point, resolve as many issues as possible before completion of audit. So you as a revenue authority, you as a taxpayer, don't just sit for them to audit and walk away. Resolve their issues, ask them, so what issues have you identified? Provide them with the documents to drop those issues. Why do I say this? Once an assessment is issued and the CG has seen that assessment, it becomes very difficult to drop further issues at that point in time. So with the audit with the officers in the field, remember, you understand your business better than anyone else. So it may be an issue of interpretation, an issue of where you're not agreeing on the interpretation of the law. So what you need to do is to ensure that you engage them and have issues closed out as many as possible during the audit. Follow up with their official letter of finding. so that they don't hit you with an assessment and you're wondering, goodness, I thought this issue was dropped. With an official letter of finding, it's still another opportunity to engage. So once they give you that, you can say, let's have a meeting, let's just discuss these issues. Come with your batch of documentation to have those matters drop. Involve your tax advisors, pay any tax that is not in dispute. Remember, if you haven't complied, make a decision to pay that tax so that they also feel that, yes, we audited, we caught these areas, this we've decided to agree to disagree, but this tax liability has crystallized. Respond to KRA timely. Why is this the case? If you don't respond, remember, they get reshuffled. You gave all your information to one revenue authority officer, they're no longer in that station. Why? Because you did not follow up on it timely. Then another audit happens. You gave all the originals to them. There is no one to trace. And as you give the originals, please, I always advise taxpayers, have an acknowledgement letter on the top that the KRA officer will sign and say, I have received this, and so that you can use that in case the same information is asked for by another revenue authority officer. So just to give you a snip of the appeal process, you've gotten the audit findings. When you get the audit findings, I mentioned as much as possible, try and drop the issues at that point in time. Give them time, create time in order to resolve the issues there. Once that happens, you will now receive an assessment. With the assessment, you have 30 days to object to that assessment. Okay? You will receive the assessment and you have days in order to object to that assessment. If it is for customs, it's provided under ICMA, and the Income Tax Act also provides for that as well. So 30 days to object to that assessment. The assessment will go to a team called the IRO. This is the independent review team that looks at your objection. They may ask for additional information in order to have the issue dropped. Okay. Once that happens, you've objected, the commissioner is given 60 days to respond to that assessment. For customs purposes, it is within 30 days. He will either allow the objection and the entire liability is dropped. He will allow it in part and tell you, I agree with you, but I disagree with you on this other front. And he may decide to disallow the objection in its entirety. So what we've seen with most taxpayers is that they fail to object to the assessment within 30 days. So you lose your opportunity for objection. You can actually apply to do it out of time. What we're also seeing is that the commissioner, because he's given 60 days, sometimes he may write to you on the 59th day to ask for more information. Effective 2019, he's allowed to do that. So time starts to run again on that 59th day. So I know it can be a bit annoying for you taxpayers because in essence, if he does not respond to you in 60 days, he hasn't sent you a letter requesting for additional information, what should happen is that the objection will be deemed to be allowed. So once you've done that and the commissioner has given his decision, you're still not comfortable with that decision, you can go to the Alternative Dispute Resolution Department. That's the ADR. But before you go there, you need to lodge your appeal to the Tax Appeals Tribunal because you need to do that within 14 days. So the notice of appeal is filed within 30 days, and then you have 14 days to put in your statement of facts and your memorandum of appeal. The reason as to why you're required to do that is that if the ADR process does not work out, you do not lose out on your opportunity to appeal at the tax tribunal. So as you see, taxpayers, you have opportunities to have that matter resolved. So just don't sit on that assessment. If you need help, contact a tax advisor, or if your auditors are working as your tax advisors, have a chat with them. Because if you lose the opportunity, the liability crystallizes, your bank accounts might be attached. Emerging tax issues. This is an area that I would like to discuss as well, because it has an element of proactivity by a taxpayer. Why do I say that? As I mentioned earlier, I sit in the tax committee for the Law Society of Kenya and the tax committee for ISPAC. And we do a lot of tax lobbying or tax engagements. Let's call them engagements because we do it for the benefit of taxpayers. So as you're aware, the Constitution actually says, that's under Section 118 and 119, that citizens are required to participate in the development of laws. So we do a lot of this from a tax perspective, through the Finance Act, through the Tax Laws Amendment Act. But I feel that taxpayers, and most especially SMEs, rarely leverage on this opportunity in order to shape legislation. When I look at some of the things that SME does, they go to government to ask for, give us funding to assist the business. What about this time we decide to go and say, please change for us the tax point for VAT, so that it's not on invoice date, it is when I'm paid, because that's really important for an SME. It has a direct impact on their cash flow. So I would like to encourage taxpayers, if there's this opportunity for government engagement, because you understand your businesses better, let's engage further. Through ISPAC, send us your submissions, through your associations, be it Kenya Association of Manufacturers, be it KEPSA, in order to drive the legislation, because it is you the tax will be levied on. So the emerging tax space is very critical, because as I mentioned, government is really trying to increase its tax base. However, the pain is being felt by the businesses, because they're the ones who are taking up the additional taxes. The penalties for non-compliance are very high, and therefore complying is critical for each taxpayer. So let's look at some of the emerging tax issues. The VAA assessment. Most of you, including me, who's a tax advisor, has received a VAA assessment. It takes a lot of energy to resolve this VAA assessment. The VAA assessment is telling you that you have claimed input here, but the other person either has not declared the output, or maybe he declared the output, missed an invoice number, or missed a specific thing on as he keyed in that information on his iTax platform, and therefore there was a mismatch. So what does that do? The system sends it back, it flags it, there's an inconsistency. Now, we've had a lot of engagements with government on this, because the inconsistencies were even arising from a full stop. You know, the other person has put the invoice number and maybe has put a full stop after that. That creates an inconsistency. So what KRA has done is increased the threshold so that not everything is causing the inconsistency. However, you as a taxpayer has to be very careful, the person who's inputting this information in the tax return. Ensure that they know what they're doing in order to reduce the instances of the inconsistencies. But even with that, the inconsistencies will arise. Why is this the case? Christine has rendered a service to NIC Bank, NCBA. NCBA has claimed the input on their end. Christine has not declared that in their VAT return. That throws out an inconsistency immediately. So we've seen the reduction. They're not as many as we had last year, but they caused a lot of issues last year. And even in some instances, you're having a tax liability on your iTax because a debit note was raised immediately, the inconsistency arose. So the feedback we've gotten from government on the VAA inconsistencies is that they're putting up a new system. It's called Teams, which will be effective 2021. They're still rolling it out to see how it will work. So that once Christine raises the invoice, that there's a trigger immediately at KRA. And with this, we hope that the inconsistencies will reduce. Now, another change that came in, which is very dangerous, we actually submitted on it last 2 weeks ago at the National Treasury, is a change that came in through the Finance Act 2020, where they are saying, for me to be able to claim input as Christine, the other party must have declared it in the VAT return. Why do I say this is dangerous? It's because it will affect Christine's cash flows. Remember, I'm paying my output VAT when I'm raising the invoice, but you're stopping me from claiming the VAT because the other person has not declared. You can imagine me as Christine, if I have like 1,000 transactions, will I have to start sitting and checking, has she declared, has the other person declared? It will cost me a lot of time. Government is actually pushing the obligation on me to check whether that other person has actually declared. They are more or less validating the VA assessments. We pushed back. Government gave us feedback. The reason as to why they did this is that there were so many missing traders, people who are claiming fraudulent input VAT. So I would have like output VAT, and then I generate a lot of invoices for input VAT and claim them. But the pushback we gave them is, now you put in this law, it's affecting that client who's been consistently compliant, because you're just trying to catch that one who has been doing illegal transactions. It's very painful on a taxpayer, and we are hoping that with the coming into effect of TINs, this issue will come to an end. So that's from a VAT perspective. Minimum tax. You've heard about the issue of minimum tax, and maybe just to provide context, there's even an application that was filed by the Kenya Association of Manufacturers to stop the application of minimum tax. We are following closely on this. And maybe just to provide some context on minimum tax, the law says it shall be payable by a person if that person is not exempted from tax, if it is not in respect to employment, residential, rental, and capital gains. It shall be payable if the installment tax is lower than the minimum tax, and the person is not engaged in retail price, where the retail price is controlled by government. So they're excluding the oil marketing companies and the insurance business. But these two came last year after there was a lot of engagement by these two sectors. We were hoping, as ISPAC and the Law Society of Kenya, we actually were pushing for the abolition of the minimum tax. It didn't go through, but we are trying to see how well we can have it streamlined, because it will definitely affect businesses. So who pays minimum tax? So maybe just to provide context, so minimum tax is based on turnover. So me as Christine, I will review my business. Maybe my turnover is $1 million, but maybe my expenses were 1.5 million, and therefore I'm in a loss position. Government is saying that I need to pay 1% of my turnover as minimum tax. So it is payable by a person. Who's a person? The Act defines a sole trader as a person, a partner in a partnership, and a company. So you as a sole trader, you can't say, I am not subject to minimum tax. You're actually subject to minimum tax. Partners in a partnership are subject to minimum tax. Remember, for partnerships, we don't tax the partnership, we tax the partners. A company. Why was minimum tax introduced? The feedback we got from government is a lot of companies report losses, and therefore they need a fair share. But the sad thing is that you may be reporting a loss because of very good reasons. Case in point, last year was a COVID year. Most companies actually will report losses in 2020, 2021 as well. So where are we even getting money to pay this tax? The Act even doesn't tell you what gross turnover is. So you can imagine, for a company that is in tours and travel and maybe sells packages, as part of their gross turnover, they've put in the air tickets, they've put in the accommodation, the hotel charges. If they're to pay 1% of that, that will definitely affect their cash flows, because most of that money is actually going to be paid to the airline or to the hotels. Sadly, it is not a future tax credit. You're not being told, pay the minimum tax now. I understand you're in a loss, but when you turn profitable, you will offset. Sadly, it doesn't work that way for minimum tax. That's why there's been such a push. Your tax losses, remember you're allowed to carry forward your tax losses, but you're not getting the true benefit of those tax losses, because even in a tax loss, you're being required to pay a minimum tax, which is 1% of your turnover. Can you use withholding tax to offset against minimum tax? This was not in the legislation, but based on a guideline that was published by the KRA, they said if you have withholding tax and you have DST, you can actually use it to offset against minimum tax. Remember, as Christine, I do consultancy work as Alpha. My turnover is already being subjected to 5% withholding tax. So you can't expect for me to pay another 1%. So we've been allowed for, if your withholding tax and your DST, that's a digital service tax, is higher than your minimum tax, you do not need to pay your minimum tax. As I mentioned, partnerships are not exempted from minimum tax, but the law doesn't say, how do I allocate the turnover onto the partners? Will you use a partnership model? So we expect a lot of clarifications to come through the KRA and Treasury in respect to the minimum tax. They've published guidelines, but our push, based on the submissions we made 2 weeks ago to the National Treasury, is an amendment of the legislation through the Finance Act in order to take cognizance of the issues that taxpayers have in respect to application of the minimum tax. And why has there been a lot of pushback on minimum tax? One, because of the adverse effects of COVID. Businesses are already struggling to meet their variable and fixed costs. Now you're telling them on the 20th of March this year, I want you to tell me what is your turnover, April, what is your turnover, and pay me tax in respect to that. There is no cash flow. Cash is king. Businesses are trying to deal with issues of restructures in order to try and survive. So a requirement to pay minimum tax by an already cash-strapped enterprise will affect its ability to survive, to reinvest, maintain its workforce, and this will definitely impact PAYE. So the multiplier effect on some of these taxes are yet to be felt. The feedback we've got from government is that the tax will apply. We will review it as we go on. So remember, you will need to still comply with minimum tax, but we hope that the application that was done goes through by the Kenya Association of Manufacturers and the retail traders as well. As I mentioned, you as a business may have invested significantly on capital expenditure, and you've got capital allowances that have put you in a loss position. Minimum tax will certainly hit you because you are carrying forward a loss because of the investment allowance. Now you will carry it forward, but you will still be required to pay your minimum tax. So you really need to carefully look at your business in order to evaluate what would your installment tax have been, what's the minimum tax, what is the impact on this on my business at this point in time. Another business that will be affected by minimum tax is the tech companies. They significantly invest in the first years of business. Most of them actually report losses. Now, government is saying, okay, you might be reporting losses, and I understand you have invested significantly on assets, but I still want 1% of your turnover. So as a result of that, you as a tech company may feel the impact on your cash flow because of the payment of minimum tax. We explained this to government. We actually even went with a tech company, which confirmed that it takes about 5 to 7 years for them to start before they become profitable. We were hoping that they would be excluded, but I know the challenge for government was, how long will this exemption list be? We've now excluded the marketing oil companies, we've excluded the insurance companies. If we are to exclude everyone, how much exclusion can we give? That's why this year, as the Institute of Certified Public Accountants, we went with a different strategy where we are telling government, let minimum tax apply if I have reported losses for more than 5 years, as it has been in other countries like Tanzania and Nigeria. We also told government, reduce minimum tax, 1% is high, consider 0.2.5%. We've also told government, can you reconsider the base? Let it not be on turnover. Consider it on the profit amount, you know, or the earnings before interest and tax. So those are some of the recommendations we gave government. We hope that they will hear our request in order to reconsider amending the law on minimum tax. Last year, we pushed for it to be removed because it really didn't make sense, taking into account that companies were getting off a COVID year. Same thing with startups. It takes time to invest. I know NCBA is very passionate about startups. These startups take about 3 to 5 years to turn profitable. And as a result of that, for them, the minimum tax will have a cash flow impact. Last but not least, the businesses with low margin. So evaluate your business. If you're a low margin business, minimum tax will definitely have a hit on you. So consider supermarkets where the margins are very narrow. If they're to pay 1% of their turnover as minimum tax, that will significantly affect their tax, their cash flow. And you remember, for most of these businesses, they're actually working on a very tight working capital. So they were actually part of the group that has gone to filing an application in order to stop the implementation of minimum tax. You may be asking yourself, what's the difference between minimum tax and turnover tax? So turnover tax is slightly different because it's optional. You may review your business and say, I want to go the turnover tax route. And this is for a business that has a turnover of less than 50 million. But doesn't mean you don't need to comply for VAT. If your sales are more than 5 million, you will still need to comply from a VAT perspective. So turnover tax is more or less like minimum tax, but turnover tax is optional. You don't have to go for turnover tax if it doesn't suit your business. But some businesses cannot go under turnover tax if you're offering consultancy, if you're paying if you're offering services of royalties, rental income, those cannot go under turnover tax. So minimum tax applies to everyone as long as you have not been excluded under the provision of the law that we've looked at. Turnover tax is optional. A business may decide, I want to go turnover tax, you register for turnover tax, and you meet the obligations under turnover tax. Digital service tax. This is a new emerging issue as well. The digital service tax is a tax that is payable at the rate of 1.5% by both resident entities and non-resident entities. The 1.5% is on the gross transactional value. And it's payable on services that are derived or accrued in Kenya through a digital marketplace. Now, for a resident company, it is an advanced tax, and I will use live companies. So for example, Jumia will be subjected to digital service tax, but that 1.5% will be an advanced tax. It is not a final tax. Meaning that once Jumia does its corporate tax affairs, determines its corporate tax liability, they will get a credit of the 1.5% they paid. For a non-resident, it is a final tax. Case in point, Facebook has rendered services, Facebook has paid the DST of 1.5%, it is a final tax. Now, what are the services that are subject to digital service tax? Remember, we stated that these are services that have been offered through a digital marketplace. The Act has defined a digital marketplace as a place that brings in buyers and sellers together. Case in point, Jumia brings buyers and it brings sellers together. They get a commission. That commission is subject to DST. Over and above that, you have a person rendering services on a digital platform. That person will also be subjected to DST. Case in point, influencers. I mean, those are people we can relate to. They do a lot of advertising through a digital platform. They will be subjected to DST. So some of the services include over-the-top services, including streaming television shows, film, music, podcast, any other digital content, provision of a digital marketplace, so like Jumia, Uber, Glovo, they are all providing a digital marketplace. Those will be subjected to DST. Airbnb as well. Electronic data management, including web hosting, online data warehousing, file sharing, and cloud storage services. I know this is one where we engaged government and told them, but this year we are not bringing in buyers and sellers. We are actually just storing the data on cloud, and they said, you understand what we mean. We were targeting all those services. Sometimes we may not be very clear, but we as lawyers, clarity of the law is very important. Another one that we really engaged them was on this one, electronic booking or electronic ticketing services, including the online sale of tickets. I mean, I pay for maybe a show, and I attended a show. The service is not really being rendered on the digital platform. It's just the sale of the ticket. So there are quite some challenges into the implementation of some of this, and we expect that we'll get more clarity in law as we move on. Any other service provided through the digital marketplace, those will be subjected to DST. And one of the questions we had is, if already the service is already been subjected to withholding tax, will DST apply? The feedback we got from government is no. If withholding tax is being applied, you do not need to account for digital service tax. Okay, but we will also get some issues arising from the interplay between DST and withholding tax. Remember, withholding tax is at 5%, DST is at 1.5%. So for example, Christine, rendering this virtual training, normally when I do the normal trainings, it will be subjected to withholding tax at 5%, but is in this training through a digital marketplace. It's a virtual training, and it has been captured under online distance training through pre-recorded media or e-learning, including online courses and training. I would prefer if this service is subjected to 1.5 DST as opposed to 5%, So we expect some issues arising from the interplay between DST and withholding tax. The scope of taxable services. Mobile money transactions are not subject to DST. That's one of the questions that we've been receiving from taxpayers. Government online services are also excluded from DST. So it says that online services which facilitates payments, lending, or trading of financial services, commodities, or foreign exchanges carried out by a financial institution or a financial service provider, those will not be subject to DST. That's the digital service tax. Who is the target of DST? As I mentioned, it is both residents and non-residents. You will be required to register. We've seen a lot of non-residents starting registration of DST on the iTax platform. What's the base of DST? It's on the gross transactional value, excluding VAT. So you do not put in VAT when determining the base for the DST. So it's on the amount excluding the digital, excluding VAT. As I said, it is both by a non-resident, so a non-resident may register under the simplified system. It's actually very easy on the iTax platform, or appoint a tax representative. The resident will need to update their PIN registration details in order to enable them register for DST accordingly. Who pays the DST? Now, remember, the DST is payable by the digital service tax provider. You as a recipient of the service Do not allow that other person pass that cost to you. It is their tax. The digital marketplace provider, the one who's providing that digital marketplace, is also the one who's supposed to account for the DST, for the services he's provided on the digital platform. The due date is 20th of the subsequent month. Please, if your services are subject to DST, please ensure that you comply, because a penalty of 100,000 every month will crystallize if you do not register for DST. If you haven't registered, consider registering. You can give reasonable grounds why you're late, but I would kindly request that we start compliance in order to avoid crystallization of penalties and interest. The tax amnesty is actually the last section that we will cover this morning. The reason as to why I feel that it's very important to talk about the tax amnesty is because it's an opportunity for you as a taxpayer to proactively manage your tax affairs. Why do I say this? As I mentioned earlier in the presentation, government is becoming extremely aggressive. As you will note from what they published on the KRA website, they're increasing their comprehensive audits. So it is important for you as a taxpayer to look at your tax affairs, take advantage of the tax amnesty for the period 2016 to 2020, pay any tax liabilities that they may be, apply for the waiver of the penalties and interest, and you'll actually get 100% waiver of those penalties and interest. How does this help as well? It more or less locks that period from another audit. It becomes easy when you get a letter from KRA saying that we would like to audit 2017 to 2020 for you to tell them, actually, we already audited ourselves, we took advantage of the tax amnesty, and we paid the liability. It doesn't mean it will stop them, but I mean, they will be more softer. They can actually say, okay, if you did that, we will not audit. If you don't take advantage of the amnesty, it's so hard to push back if they decide to come and do the audit. So this is a voluntary disclosure program that runs for the next 3 years. That's 2021, 2022, and 2023. If you pay your tax liability this year, you will get 100% waiver of penalties and interest. If you pay 50% in 2022, if you pay the tax, in 2022, you will get a 50% remission of the penalties and interest. If you pay it in 2023, you will get a 25% remission. You get immunity and waiver of penalties and interest. The period covered is 1st June 2015 to 30th June 2020. So you look at your tax affairs for this period and declare the tax liability. You may not have the cash upfront. You can actually agree on a payment proposal with KRA. It will be written. The beauty about it is that the penalties are not accruing anymore because you will have gotten the waiver of penalties and interest, and work it out so that you pay this tax in 2020 for you to enjoy the 100% waiver. If something moves to 2021, the remission will only be you will have settled most of the liability in 2021, so you get the full advantage. Sadly, if you have an ongoing audit, or you have received a notification of an audit, you're not eligible to the program. This is very important for you as a taxpayer. You do not want to receive a notification now, and you are considering taking advantage of the amnesty. If you are considering taking advantage of the amnesty, start off the process early. For some of our clients, we've actually even written to the KRA and told them, we are considering taking advantage of the amnesty. How does that help? It stops KRA sending a letter of an intention to audit. Because if they send that letter, you lose your opportunity for 100% waiver of penalties and interest. As I said, You cannot take advantage of it if you have an investigation or the matter is under litigation or if you've received a letter of intention to audit. You might have received a letter of intention to audit and it covers corporate tax and PAYE. Doesn't mean you can't do a self-disclosure for the other taxes, VAT and customs if you have that. The beauty about that is that when they come to audit this and you have taken advantage of the amnesty on the other taxes, they will not expand their scope. I mean, it will prevent them from expanding their scope. So just review your affairs, see whether amnesty is something that you would like to consider so that you can consider taking advantage of it. What are the advantages of the tax amnesty? As I mentioned, it's a way of tax planning because you get a full waiver of penalties and interest. Secondly, it to some extent from a soft, I call it soft, in a soft way, closes that period for a tax audit. The tax amnesty also helps you improve from a compliance perspective because you'll realize, let's say you involved a tax expert to just come and look at your tax affairs. They will tell you here, you should have been doing this and that, as opposed to how you've complied. So it improves your compliance perspective. The tax advisor can also tell you, what about you to structure your operations this way to take advantage of this tax planning opportunity that you have not been taking advantage of? So the tax amnesty has a lot on it. I know we might be afraid because you may be saying, I'm exposing myself too much. But remember, the system is already interconnected. And I showed you the interconnection. From a corporate tax perspective, withholding tax is already sending signals to government that we expect the corporate tax. Withholding VAT is already triggering KRA and saying VAT should be remitted by this client. We are not seeing it. So when KRA is doing their profiling, they're looking at all this information to know where do we need to do our audit next. You see, so yes, you may be exposing yourself, but it is necessary because it's just a matter of time. KRA will come knocking. As I said, you may not have cash at this point in time. Consider a payment plan. They've actually been approving a lot of payment plans for purposes of compliance. If the liability is on the iTax platform already, might be very difficult on getting waiver of penalties and interest on that because it's more or less assumed that the system already acknowledges the debt is in existence. So what do you need to do as a taxpayer? Engage your tax advisor for a tax health check or a tax health check review. Discuss issues arising and arrive at a position on areas of potential exposure. I know there are some places where you would say, no, I think my position on this matter is this. That's a gray area. But you will have that in mind and say, I know this is something that KRA may pick up and this is an issue that may end up in court. That is okay. But there are areas where it is black and white. The tax wasn't paid. In those cases, you would say, I know this exposure is due, paid under the amnesty, get your waiver of penalties and interest. Plan your cash flows accordingly in order to settle your principal tax. As I mentioned, government is agreeable to a payment plan. Put in your application for waiver of penalties and interest. Have good ground so that it's very clear in order to enjoy that 100% waiver. And then ensure compliance going forward as a taxpayer. Take advantage of tax planning and tax optimizing opportunities. Remember, within the legal framework. That is what tax planning is all about. And with that, that's the end of my presentation this morning, and I'm ready to take questions. Over to you, Stephen and Tyrus. Thank you.
Thank you, Christine. Very well done for unpacking this quote unquote quite complex topic on taxation. I know a couple of questions which are all directed, fortunately, to you.
Yes.
Maybe I can pick a few for you, and I think the first one I saw is if I'm a forex dealer what do I need to do about taxation? I guess this was asked in the context of the digital tax. I saw another question of if I'm working from home, what documents do I need to use to prove that I can be able to apportion rent? Maybe you can take those two first, then we proceed.
Okay. If you're a Forex dealer, you really need to review your transactions in order to confirm whether DST applies. Remember, when I talked about financial institutions, the one that were excluded from DST, there are those that have actually been registered as a financial institution under the law. It's provided under the law, and those that have been registered by the central bank. So Forex dealers will really need to review their transactions to confirm whether DST applies. So how have they been registered? Have they been registered also with the Capital Markets Authority? So there's a bit of advisory work that will go into that perspective in order to confirm whether DST will apply, because in essence, they're bringing buyers and sellers together on a platform. So there could be an exposure from a DST perspective, but more will need to be looked at in order to confirm the form of the registration that they've taken up and how broad the services are. The second question is in respect if you're working from home. Yes, that's a very good question. And I actually mentioned ways in which you can ensure that you're compliant. So remember, we work on a self-assessment. So it is me who tells government, this is my income, this is my expenses, this is my tax liability. Government will come in, that's in KRA. KRA will come in and check. You told me your income is this. I confirm your income is this. You told me your expenses are this. Let me check your expenses. Provide me with support. So if I'm working from home, I need to be very keen to ensure that my expenses are well documented. So now I do not have rental space. Section 15 says, expenses are allowable if they are wholly and exclusively used to derive income. So I'm deriving income because I'm doing most of my work virtually. My expenses, I am sitting at home, but I am paying rent for my home. Have a way to apportion that rental expense in order to attribute part of that expense to your business because you're actually working from home. So you have your lease contract with your landlord. The lease is maybe for 50,000, and that's just an example. Then you can be able to demonstrate for the services I'm using in this house, I can directly attribute 10,000 to the space. Document that so that when someone is coming to challenge your expenses, you have proof. And because the burden of proof is on you, you're able to you're actually able to provide that document to support your expenses. Telephone bills. You can buy now, you can get a printout of your telephone expenses, have it documented. You pay for Zoom costs. Most of us pay for transactions. Sometimes we forget to even ask for the invoice. You know, you're meeting clients now more than because you're working from home. Maybe you have to travel to their destination. You've got fuel costs. Keep that receipt. What I'm asking is that most of SMEs are not very good at document retention. And this is because most SMEs are run by the business owners. Not all of them are accountants. And even those who are accountants are not so good at maintaining documents. Get a file or have everything on soft, upload it in cloud so that you can be able to support your expenses accordingly. Thank you, Steve. Over to you.
Thank you. I'll take two more questions. There was a question on if my company was loss-making,
yes.
Should I still pay the 1% minimum tax? And question number two is, where do I get assistance to file my tax returns? I think the statement here was KRA, it's a bit busy and filing returns is a bit complex.
Okay, so minimum tax. Yes, if you're in a loss position and you do not fall under the exemption that I spoke about, yeah, you will be required to still pay minimum tax. Why is that the case? Because if you're in a loss position, your installment tax is actually zero. Because with minimum tax, what you're doing is that you're comparing what's my installment tax, what's my minimum tax, and you're required to pay the higher. So if you're in a loss position, your installment tax is zero, because installment tax is based on your taxable profit. Yeah, you'll be required to pay 1% of your turnover. But if you have withholding tax and you have DST, you can use those as a credit to reduce your minimum tax liability. Remember, the Act defines a person to include a sole proprietorship, a partner in a partnership, and in a company. So even as an individual, if you offer tax consultancy services as Christine, I'm trading with a business name as Christine, I'm a sole trader, I'm required to account for minimum tax at 1% of my turnover. Okay. With respect to filing returns, you can seek the services of a tax advisor. We do that. I know Stephen and Tyras, you could share our contacts. We could help you with that. KRA are also very good, actually. They assist a lot of taxpayers with filing of their returns. They're also doing a lot of webinars to enhance tax compliance as well. So that's also available at KRA as well.
Okay, thank you, Christine. The next two set of questions is, should cashiers pay tax? And the next question was, if my company didn't have any activities in 2020, must I still file the statutory returns with KRA?
Yes, you will still be required to file your statutory return with KRA at the 30th of June if you're a December year end. It's actually 6 months after the year end, so it depends on your year end. Yes, it is important, even if you did not have if you do not have any income coming through. Remember, you could be having expenses. So if you had expenses and you don't have minimum tax, please file your tax return, because those expenses will put you in a loss position. And because you have zero income in 2021, remember, even in 2021, minimum tax won't apply to you because you have zero income. I'm not saying you're in a loss, you have zero turnover. So the expenses from 2020 are critical. File the return so that they are recognized in the system, so that they can be used to reduce your tax liability in the future. So that is critical. Stephen.
Thank you. I think the last two questions is, how do I access tax amnesty program?
Okay. So the tax amnesty program, how you access it is that you do a health check. So you review your transactions. You could do it through your auditors, or you can seek the services of a tax advisor. For the period 2015, that's June 2015 to July 2020, they come and review your corporate tax. They check, have you been filing your corporate tax? Have you been filing them correctly? Your VAT, have you declared all your output VAT? Have you declared all your VAT transactions? Have you claimed your input VAT? Withholding tax, you received the services which were subject to withholding tax. Did you deduct withholding tax? PAYE, you gave all these benefits to your associates, or you even paid yourself. Did you subject it to tax? So once you review that, you determine what your tax liability is. After you've determined what your tax liability is, you put in your amnesty letter. Actually, you can do it also on the iTax platform. And if you have your relationship manager, you can, at KRA, you can actually work with them in order to assist you with the process. You put in your application for amnesty, you pay the tax liability, and you enjoy your 100% waiver of penalties and interest if that tax liability is paid in 2021. You get a 50% if paid in 2022 and a 25% if paid in 2023. As I mentioned, you can agree on a payment plan if you do not have enough cash to pay in 2020 or to pay as a one-off payment.
Thank you. There's a follow-up question on the issue of rent apportionment. There's
Yes.
somebody was asking, assuming I own that home, I'm working from my own home.
Yes.
How do I apportion my costs, my rental costs?
Okay, so you could be working from your own home. Maybe you're paying a mortgage. I think here, Steve, what we're trying to say is that you should come up with an attribution way that can be justified. Maybe for that house, you're paying a mortgage payment. You have installment payments that you're making every single month. Can you attribute part of that installment payment to the rent as rent? Okay, you can actually even just demonstrate to them, when I was in business, I had taken up space in this building. This was my rent expense. This space is slightly lower, so I've taken 50%. What we're just saying is that, can we just get a bit of it and attribute it to the rental expense in my house and use it to support my expenses?
Thank you. Finally, this is a final one. When does VAT and pay as you earn become an obligation for a newly registered company that has no employees?
I like that question, because what happens is that we are very good at incorporating companies, Stephen. So you get this tender, you say, I want to incorporate a company. Nowadays, it's even easier because you don't need the services of a lawyer. You can go and incorporate it by yourself. Then you go to the tax registration. That's the KRA portal. And you're applying for your PIN. And you tick everything. PAYE tick, VAT tick. You tick all the obligations. You do not have an employee. You have not met the threshold for VAT. In that case, the obligation starts immediately. And we've had instances whereby an SME will come and tell me, but I don't have PAYE, I don't have VAT, but I'm seeing penalties accruing on the iTax platform. And we go back to their registration document and they ticked it themselves. What we are saying is that even as you register that company, be extremely conscious. So for example, for you to register for VAT, your turnover or your expected sales should be 5 million and above. So this year, my turnover, maybe I'm starting off this year, I do not expect it to be more than 5 million. In that case, if I'm registering my company, I do not need to register for VAT at this point in time. When I realize that I'm meeting the threshold for VAT, I will now go back to my iTax platform and update my PIN registration to include VAT as a tax obligation. I know for some of us, we may decide to just register for VAT immediately because the services we render, the other person wants an ETR invoice. If that's the case, yes, register for VAT, but know the obligation has crystallized. So if you have no sales, every single month, go to the nil section, file nil return, very easy. Click nil return, I have no sales. So meet your obligation. Choices have consequences. If you register for VAT, you have to file the return. So review your business. If you feel that I don't think I'll meet the VAT registration, don't register for VAT at this point in time. If I have no employees, do not register for employees at this point in time. When you hire your first employee, now go to your iTax platform and register for the PAYE obligation and file the returns accordingly.
Thank you very much. I think that's all we can take for now, Christine. Thank you for your energy, your passion, and very good in terms of delivery. Titus, I don't know if there's something I've forgotten before I make my final closing remarks.
No, nothing further to add for me other than to thank Christine, I think, for a very wide-ranging discussion. My key takeaways is be proactive with your tax management. There are ways to do your tax planning that's legal, that reduces liabilities, and use a tax advisor. I think when things get complicated, there are professionals to do that job. And I think with that sort of help, I think our businesses and all of us will be better off. So thank you so much for your time and comments and thoughts. Nothing further to add other than to thank you and for everybody for their attendance. I think it was a great session. Thank you very much. Back to you, Stephen.
Thank you, Titus. My two key takeaways is that tax planning is paying the right amount at the right time and in the right way. And tax compliance is the first way to tax plan. And finally, let's take advantage of discussing with government on payment plans or KRA in terms of payment plans where we fall into default. I want to take this opportunity to thank traders. We picked at 374. I think we picked at 374. I thank all our customers for tuning in for this webinar. I thank Christine for unpacking this. Traders for giving us the business perspectives and insights around the taxation and especially around this COVID environment. I also want to, in a very special way, recognize and thank our colleagues, our relationship managers, our teams for marketing, our branch managers who have actively been engaged in engaging customers for this webinar. Thank you all. For the customers on call, I request that you get in touch with our branch managers and relationship managers, just to give you a bit of insights on the partnerships we signed with the GOK, the government of Kenya, around the credit guarantee scheme, so that we can be able to support you with your working capital and business expansion requirements. With that, thank you very much, and I wish you a very productive day ahead. Thank you very much. Santeni.
Thank you.
Thank you very much.